Welcome back to another edition of What's with Rates. This week, we're diving into the fascinating world of mortgage rates and the influential 10-year Treasury yield. Today is November 18th, 2024, and if you've been keeping an eye on rates like we have, you'll know there's a lot happening. In this video, we'll cover the factors influencing these rates, such as recent Fed rate cuts, investor sentiment, and market volatility. We'll also demystify some technical analysis tools like the exponential moving average, relative strength index, and MACD. Stick around for expert insights on how these elements interplay to shape the rates you might be dealing with. Let's delve in. First, let's talk about the Federal Reserve. Recently, the Fed announced a rate cut, which has sparked discussions across the financial landscape. Fed rate decisions are a major driver of mortgage rates. When the Fed cuts rates, it typically lowers the borrowing costs for banks, which can trickle down to consumer loan rates, including mortgages. However, mortgage rates don't always move in lockstep with Fed actions. What we're witnessing now is a complex interaction of influences that also includes the 10-year Treasury yield. The 10-year Treasury yield serves as a benchmark for mortgage rates. When investors are optimistic, they might seek out riskier investments, leading to a sell-off in treasuries and, subsequently, higher yields. Conversely, in times of uncertainty, investors flock to these safe haven assets, driving yields lower. This week, investor sentiment has been particularly sensitive to recent geopolitical events and economic data releases, causing noticeable fluctuations in the yield. This volatility can directly impact the rates lenders offer to homebuyers. Now, let's consider the role of investor sentiment and market volatility. In recent weeks, global markets have experienced a surge in volatility due to a combination of geopolitical tensions and varying economic indicators. Investor sentiment has been a roller coaster, with shifts in confidence leading to rapid buying and selling in different asset classes. This sentiment is pivotal in shaping not just treasury yields but also the broader interest rate environment, including mortgages. Intricately tied to this is technical analysis, a tool many traders use to predict future price movements based on historical data. Let's break down a few popular indicators. The exponential moving average, or EMA, is used to identify trends by smoothing out price data. This helps traders discern not just price direction, but also potential reversals. The relative strength index, or RSI, measures the magnitude of recent price changes. To evaluate overbought or oversold conditions, a high RSI might suggest a security is overvalued, prompting a price correction. Meanwhile, the MACD, or moving average convergence divergence, is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. This can be crucial for spotting bullish or bearish reversals. In the current rate environment, these technical tools are particularly useful for gauging the market's direction and momentum. As mortgage rates are indirectly influenced by the bond market, having a grasp of these indicators can provide valuable insights. For instance, a crossover in MACD could signal a shift in momentum that might prelude changes in bond yields and thereby mortgage rates. Similarly, changes in EMA and RSI can highlight emerging trends or corrective movements in the market, allowing lenders to anticipate rate adjustments. So how do these technical indicators, coupled with macroeconomic factors, shape what we're seeing in mortgage rates today? When you combine the impact of the Fed's rate cut with the technical analysis insights and current investor climate, it forms a picture of not just where rates are today, but where they might be heading. These dynamics are crucial for anyone looking to finance a home or refinance their current mortgage. It's an intricate dance of forces, each element influencing the other, creating a complex yet fascinating financial landscape. As we wrap up, it's important to keep an eye on these factors if you're planning any financial moves related to mortgages. Stay informed about Fed decisions, monitor Treasury yields, and don't overlook the power of technical analysis in anticipating market behaviors. If you found this analysis helpful, consider subscribing to our channel for more insights into the ever-changing world of finance. Leave a comment below with your thoughts or questions about this week's mortgage rates. We're here to help you navigate these waters with confidence and clarity. Thanks for watching, and we'll see you next time on What's with Rates?